Hello, everyone. My name is Matt Vanderloop, and I'm a principal and the CEO here at SVA. I'd like to welcome you to our webinar on Wisconsin Economics Outlook for today. Before we get started, I want to take a minute to say just a few things about SVA. Our vision is to remain independent, and our goal is to continue servicing the same clients we have since 1974. Closely held businesses, family-owned businesses, nonprofits, and high net worth individuals. And our mindset hasn't changed over these last almost 50 years. And that's that if you're a business owner, shareholder, a partner in a business, your business is more than just a job. It's an integral part of who you are. So it's incredibly important that your advisors are there for more than just the compliance issues that come up, but that they're working with you collaboratively and consultatively to help you achieve your goals. And that's our goal at SVA. And today's webinars and the others like it that SVA does are just one small way in which we do all of that. For today's webinar, we're planning to have a few minutes at the end for some Q&A, so please send in any questions you might have as you go, and we'll address as many of those as we can at the end of the webinar. I'd like to introduce our speaker for today. We're very excited to have Dr. Stephen Deller join us today. Dr. Deller is a professor in the Department of Agricultural and Applied Economics at the University of Wisconsin-Madison. He's also a community economic development specialist with UW-Madison Extension, and is formerly the interim director of the Center for Community and Economic Development at the Extension. His work is in the broad area of community economic development with a focus on smaller communities and rural areas. Some of his recent work has explored the community economic impacts of mining, women-owned businesses, manufacturing location decisions, and the role of taxes and public services in community economic growth and development. So when we decided to put together today's webinar to look at the overall Wisconsin economy and looking forward, you can see why we were very excited to ask Dr. Deller to join us. And we're incredibly excited and very fortunate that he was able to do that. So without any further ado, I'd like to introduce Dr. Stephen Deller.
Good afternoon, everyone, and thank you for joining us to talk about what's happening to the Wisconsin economy and more broadly, what's happening to the national economy, because kind of as the national economy goes, so goes the Wisconsin economy. And I want to kind of give you an overview of what our economic indicators are pointing to. And this is kind of the picture that we have right now. It's kind of a mess in terms of the leading economic indicators and the indicators that are pointing us in what direction we're going in. Have you ever heard the phrase, you put 10 economists in a room and you're going to get 10 different answers? Well, when we think about what's the future of the economy, you put 10 economists in the room and you're going to get 20 different answers. It's because we're getting a lot of mixed signals right now. And I want to try to explain what some of those, what some of those signals are and how they're mixed, okay? If you look at just the headlines of the national media and even the local media, there's a general kind of picture that's being painted that we're going to go into a recession. And you look at, so if this is your source of information, the thinking is, geez, we're going into recession. But just a couple of days ago, the Wall Street Journal, it's the one that's on the very bottom there, the economy showing strength in early 2023 after last quarter's GDP gains. This is kind of the why we have that picture of the leading economic indicators, because it seems as though we get two indicators pointing one direction, we get another indicator pointing a third direction, and it's there's a lot of interpretation that's going on here. So I want to try to give you an idea of what we're looking at and what the future, the next year might look like, okay? If you look at growth in gross domestic product, which is kind of the granddaddy measure of economic activity, and this is a simple growth index looking kind of a percent change from one year to the next. We've got the US, Wisconsin, and the Great Lakes. And you can see that Wisconsin follows the Great Lakes pretty closely. You can see that there's growth. You can see COVID stepping in. You can see COVID coming right back out again. Okay, so if you look at this, and this is going up to the third quarter of 2022, that's the most recent year that we have state level GDP data. If you look at the last couple of quarters, it's essentially saying, well, we're growing fine. What's What's the problem? Well, this is in nominal dollars. This is not taking out the effects of inflation. If we take out the effects of inflation, we get a different picture. The black line is Wisconsin GDP growth in nominal dollars, and the red line is taking out the effects of inflation. We get a very different picture here. Coming out of the recession or coming out of the COVID recession, you can see that the growth for Wisconsin has been fairly flat. And it actually took us a little while to get to where we were before COVID hit. But if you look at the last couple of quarters, notice that it's basically flat. So what's happening here is that in nominal terms, we're not taking out the effects of inflation, we're seeing growth. The problem, though, is that inflation is eating away at that growth. Okay, let's look at personal income. Again, this is a growth index, Wisconsin compared to the nation and the Great Lakes. And again, you can see how Wisconsin kind of tracks along the Great Lakes. Now, notice that there are two kind of spikes in the data here. The spike when COVID first hit, and then a second spike in the first half of 2021. Now, what this is that you would think that with GDP dropping the way that it did, that you would see personal income dropping because people are shifting from employment to unemployment insurance if they're covered by unemployment insurance. What these two spikes are, this is basically federal stimulus money. The federal stimulus money was essentially kind of coming in and saying, we've got a medical emergency, we got a public health emergency, we've got to shut down the economy for public health reasons, and we're going to try to help people become whole by giving them money. So we're seeing these two spikes here, okay? Now, again, this is in nominal terms. Look at the last couple of quarters. Again, the most current is third quarter of 2022. And again, you can see growth. If you were to put a trend line in here, you would see that we're kind of following that long-term trend line of growth. There's no signs of an economic slowdown here. But again, let's take in the effects of inflation. The black line is Wisconsin's nominal personal income growth. The red line is we're taking out the effects of inflation. It's real. You can again see the two spikes of the federal stimulus money coming in, but look at the most recent time period, okay? We're actually seeing real personal income going down. Not only is inflation eating away at the growth, it's actually pushing us backwards. Essentially, we're hearing a lot about labor shortages and how employers are raising wages to attract and retain workers. So you're hearing workers saying, whoa, I got a 5% pay raise. Well, you would expect, and that's what's being captured in that nominal, that black line there, okay? But inflation is at 6 and 7%. So actually, rather than a 5% pay raise, you're actually taking a 1 or a 2% pay cut. And that's what this graph is saying. So inflation is eating away at the recovery. Now, one of the things that's driving inflation here is how people are spending their money. Okay, this is personal consumption expenditures. And the most recent year we have is 2021. We don't have the 2022 data yet. And you can see that Wisconsin, again, parallels Great Lakes. The national average, the U.S. average, is a little bit higher. That's because Wisconsin's per capita income tends to be below the national average. Excuse me. We don't have as much buying power as the national average. But notice that we went into the COVID, people hunkered down, they cut back on their spending, okay? And then there's that strong recovery. Two things happened here. One is that people were made whole by those stimulus checks, okay? Some people actually came out ahead because of those stimulus checks. They were kind of saying, okay, well, we're in hunker down mode. We're not spending. And as we came out of COVID and into 2021, there was a lot of pent-up demand. People essentially said, all that deferred spending, I'm going to make up for it, and I'm going to make up for it now. So we're seeing a spike in consumer expenditures. So that's essentially, if you can think of a supply and demand curve, that's a shift in demand. Okay, it's shifting outward. Now, the problem, though, is that we still have problems with the supply chain. We still have what I refer to as bubbles in the supply chain. It was really evident when you looked at, like, say, car lots, used car lots, new car lots. They were vacant. Why? Is because they couldn't get the parts to make the cars. So we still have those bubbles in the supply chain. That's restricting supply. So if you've got demand accelerating and you got supply kind of being constrained and actually pulled backwards, that's a recipe for inflation. And that's exactly what we're seeing right now. Okay. Now, if you look at employment, okay, you can kind of see how with COVID, we basically shut the economy down. Okay. But that's probably an overstatement. I mean, if you look at that drop off, that's as close as you come to shutting off the economy. But notice that from the peak right before, okay, to the drop, we lost about 15% of employment. Okay, the nation lost a little bit more, but we lost about 15%. That means 85% of the people were still working. Okay, and a lot of those 85% of folks that were still working got some of that stimulus money. Okay, you can see the recovery. Okay, but notice how Wisconsin, even before COVID hit, the growth rate in employment in Wisconsin was modest compared to the US. Okay, the recovery coming out of the COVID lockdown is modest compared to the US. Okay, now the question is, we're not looking at just this chart alone suggests that we're not generating very many jobs. That's not true. Okay. Now let's look at unemployment rate. Okay. Wisconsin historically has a lower unemployment rate than the nation. People in Wisconsin like to work. Our labor force participation rate is historically above the national average, and our unemployment rate is historically below the national average. You can see the spike up in COVID, and you can see the return down. Now, notice that the unemployment rate for Wisconsin, and this goes up to January of, well, it goes up to, we're in March now, so it would have been back in January a couple of months ago. Okay. Notice that the unemployment rate for Wisconsin is real close to the national average. Okay. We're at about 3.5%. Now, there's a discussion amongst economists of what's referred to as the natural rate of unemployment. The economy is always in churn. Okay, a dynamic economy, you want to see a lot of business churn. You want to see businesses open. You want to see businesses closing. Okay, that's a dynamic economy. Okay, so there's always going to be a certain amount of churn in the labor market. That's the unemployment rate. Okay, now the natural rate is what is the level of unemployment that you would expect with kind of the economy churning at a rate that we would want it to do. Okay, economists argue 3.5%, 4%. It varies, but by almost every indicator, we're pretty much at full employment. Basically, everybody that wants a job has a job in the state of Wisconsin, and indeed the nation. Okay, so this starts to point at a slightly different picture. If that previous chart that we're not generating employment to the same rate as the national economy is because we're not generating jobs, or is it that we've got something else going on here? Okay, now this is a new set of data that has been released by the Bureau of Labor Statistics, and it's essentially looking at three things: openings, job openings, hires, separations, that's people that are basically laid off from their work, and then quits, people that are essentially saying, I got another job opportunity, I quit this job, I'm moving on to another job. Okay, this is that churn. Okay, that constant opening, separations, quits, hires. This is a reflection of that churn. Now, notice you can see the spike in the separations in COVID. Okay, but notice, I want you to look at the last year or so. Notice the large jump in the number of openings in Wisconsin. We have a lot of businesses that are trying to hire. Okay, but if you look at the black line, which is the actual hires, it's basically stable. It hasn't really changed since 2015. Okay. Quits is basically the same. Separations is basically the same. What we're seeing here really is that Wisconsin is generating jobs. We don't have the people to fill those jobs. That's why I think our employment growth rate is lower than the national average. We're generating jobs. That's what the red line shows here, but we don't have the people to fill those jobs. And it's not people sitting on the sidelines. Okay. This is just simply looking more recently. This is the same data, but looking post-COVID. So you can kind of see that this job openings is not, this has been going on for a couple of years now. Okay, so this is not a unique phenomenon. Okay, now this is a simple population to employment ratio, and this goes all the way back to 1969. Okay, up to 2021. Now, all this is taking the population of Wisconsin, dividing by the number of jobs in Wisconsin. And we're comparing to the US and to the Great Lakes. Okay. Notice a couple of things here. Notice that Wisconsin, the population employment ratio is almost always below the national average and the Great Lakes. This goes back to that Wisconsin people like to work. Our labor force participation rate tends to be higher, and that is reflected in this particular graph. Now, notice that in the 1970s and the 1980s and through the 1990s, that ratio is trending downwards. What that's telling us is that we're generating more jobs than people to fill those jobs. Now, so this is a long-term pattern. Okay. Now, the reason that we were able to sustain that in the 70s and the 80s is because that was a time period when women started entering the labor force in record numbers. So this kind of, we're generating more jobs than we have people. Well, we have a pool of labor called women that are entering the labor force and is allowing this to happen. Now, what's happened over the past 10 years or so, 20 years, is that we've tapped out that pool of labor. Okay. So this idea that, people are sitting on the sidelines, labor force participation rate is low, that's not what's happening here. What's happening here is that from over 60 years, we have been generating more jobs than we have people to fill those jobs. And now we've essentially tapped out our labor force. So it's becoming a binding constraint. This is why a lot of businesses can't hire people, is because there's simply no people out there to hire. Okay. Now, the consumer price index. Okay. I kind of mentioned that, if you look in nominal terms, income's going up, GDP's going up, but inflation is eating it away. Okay. If you look at the consumer price index, which is kind of our granddaddy measure of inflation, economists will argue that this is probably the worst measure of inflation. There are much better measures of inflation out there, but we use the CPI because the CPI is written into so many federal laws, state laws, union contracts. The CPI is kind of the legal definition of inflation, if you will. Now, look at the last couple of, if you're looking from, say, the 2000s up to 2021, inflation has been pretty modest in the year. It's been averaging 2%. Okay. But we see that spike, okay, particularly in the past couple of years. Again, I think that's a reflection of the fact that people have money and they want to spend it, but there's problems with the supply chain. That, I think, is what's driving inflation. Okay. Now, if you go back historically, right, you go back to the 1980s, the early 1980s, the mid 1970s, inflation was double digit and a serious fundamental problem to the economy. We're not at that stage. Okay. Anybody, if you've been around long enough, you can remember the early 1980s. It was chaos. We're not at that point now. Okay. So 2 other points. Notice that I've got consumer price index, all items, that's the gray line, and the consumer price index minus energy and food, that's the red line. Okay. Notice the difference between those two essentially is what's happening to energy prices and food prices. Notice that that gap between the red and the black line is a lot more unstable. It bounces around a lot. And the reason it bounces around a lot is because energy prices tend to be very unstable and food prices tend to be very unstable. Now, if we look at the most recent time period, you can see that energy prices spiked, but they're starting to come down. Food prices spiked, they're starting to come down. What was one of the major drivers of energy prices being spiked? If you look at the time period there, that's essentially when Russia invaded Ukraine, and it caused shockwaves through the energy markets and the food markets. Okay, so part of this inflation that we're seeing here is not just people having pent-up demand and wanting to spend and supply having a hard time keeping up with it, is that we've got the uncertainty because of the Russian invasion of Ukraine. Okay, no matter what you do, no federal policy can take that factor out of the equation. Okay, there are some things that are beyond our control, and right now, how Russia's invasion of Ukraine is impacting energy and food markets, we really can't come up with a policy to address that. Okay, so there are some things going on here that are beyond the control of federal policy. Okay, now one of the things that's unique here is housing prices. This is a simple measure of all housing price transactions. It's growth index. And three things here. One is, notice how stable housing prices are through the 70s, the 80s, the 90s, and into the early 2000s. Then we started to see it accelerate. Okay. And then it popped. That period right there in 2006, 2007, that is a classic definition of a bubble. And the bubble popped. Okay. Now, if we have time for the questions and answers, we can talk about how that played out and caused the Great Recession. You can see the housing markets recover. What is concerning now is look at the last 2 years. Housing prices have spiked. Okay. And we can talk about why this is happening, but this is a warning sign in terms of the economy, because people are looking back at what happened in the Great Recession and saying, are we repeating history? Not really, because when the housing bubble popped, it had a tremendous rippling effect on the secondary markets, secondary financial markets. Okay. Those secondary financial markets today are much more stable and much more resilient than they were during the Great Recession. So even if the housing market corrects itself, the odds of repeating the Great Recession are pretty low. Okay, but there will be a correction in the housing markets. Okay, so what do we got here? COVID impact on the economy. It was like a light switch. Okay, we turned the economy off. Well, 15% of jobs, we turn the economy off. Unfortunately, the economy is not built that way. We can't just turn the economy on and turn it off and turn it back on. It doesn't work that way. Okay, so the federal stimulus did start off a deep recession. Okay, was it too much? Did it fuel inflation? Perhaps. Okay, inflation is eating away at growth in money-based measures of the economy. That would be personal income, that would be gross domestic product. Inflation is eating those things away. Okay, federal stimulus, spending, monetary, was it too much? Perhaps in hindsight it was, but inflation is a global phenomenon. Okay, if it was simply the stimulus was too much in the US, then inflation would be a US problem. But it's not. It's a global problem. So that in and of itself kind of says federal stimulus, yeah, it had a bit of an impact, but it is not the primary driver. Okay. We got problems with the supply chains. Those supply chains are slowly working their way out, but they're still there. Pent-up consumer demand coupled with supply chain problems, we've got inflation. Okay. The Ukrainian-Russian war is causing havoc in the energy and food prices. That's starting to stabilize a little bit. We thought that Europe was going to go into, real serious problems because of their heavy dependency on Russia for energy, natural gas, and oil. Luckily, that hasn't been the case. And the reason is because the winter in Europe has been a very mild winter. So the demand for Russian energy wasn't as bad as people were thinking it was going to be. Okay. Labor market shortage. Is it putting a cap on job growth? The reason that we're not seeing job growth in Wisconsin is not because businesses aren't trying to expand and hire. They are. The problem is that we don't have the people to fill those jobs. But this is not a new issue. This is a long-term structural issue. And it's just now getting to the point where it's really impacting us. Okay. Now, where's the economy going? This is a set of leading economic indicators that is out of the Conference Board. This is a group that monitors the economy and does a lot of survey work and comes up with this index of leading economic indicators. And what this is the overall kind of index. And when it is above zero, it's positive. That's essentially an indicator that, hey, the economy looks like it's going to be growing forward. When it goes negative, that's a warning sign. Now, what they've got here is that notice that, every time it drops negative, it goes below zero. There's these black lines, and then there's the red lines. The black lines are essentially saying, warning, warning, be careful. We might be going into a recession. Okay. The red is essentially we're heading into a recession. Now, notice the gray bars there. Those are the recessions. The consumer, this index of leading indicators actually does a pretty good job of forecasting economic downturns. Okay. Now look at the most current. Okay. That's pointing to a recession. This is why this indicator right here is essentially pointing to, is explaining why so many economists and so many newspaper headlines are saying we're heading into a recession. It's because of that indicator right there. But notice that in January, it ticked up just a little tiny bit. Okay, this is part of that confusion. Now, one thing you have to be aware of is that when you look at this thing, it bounces around a lot. If you track this thing on a month-to-month basis, you can get mixed signals. What you want to do is you want to look for trends. And generally, it's like, 3 months is establishing a trend. Okay. This is the change in the leading index from the previous month. And you can see this is a trend. It's down. It's down in all of these periods. This is saying we're heading into a recession. Okay. If history repeats itself. Now, this is the big kind of the big F is that the COVID recession was unlike any other recession that we've ever experienced. You have to go back to the Spanish flu of 1917, 1918, okay, for any kind of comparison. But that's not a good comparison because we didn't really have monetary policy back then. And the second thing is we were in World War I. We were on a war footing. So even that pandemic isn't a good reference point for us. Okay. So that's the wild card is that COVID recession. Okay. Now, here are some of the indicators that go into that index. Okay. Notice that there's a fair amount here related to manufacturing. Average weekly hours in manufacturing, manufacturers' new orders. There's a lot of research that has gone into which of these really kind of do the best job. And based on all this research, these are the ones that kind of pop up. Now, if you go to the conference board, you can actually register, it's free, and you can download their set of leading economic indicators, and there's dozens and dozens and dozens of them that they monitor. But these seem to be the ones that work the best. So what I want to do is I want to kind of look through a couple of these, okay? This is the 4-week moving average of initial claims for unemployment, okay? And this is for the US. And what you can see here is that from 2015 up to the COVID hit, it was pretty stable. That was a fairly stable time for the national economy. And then COVID hits. And then you can see the recovery back down. Now, if you were to look at the most recent time period, and the most current is, again, January, if we were going into a recession, you would expect that thing to be trending upwards. But it's not. Okay. Manufacturers, new orders, okay, for consumer goods. You can see kind of the trend, a little bit of a flat spot there before COVID hit. COVID hits, the recovery back up, strong growth. Okay, that growth is trying to catch up with pent-up demand. Consumers have that money. There was pent-up supply or pent-up demand, promise with the supply chain. You can see us trying to catch up. Now, the key here is to look at the last couple of months. Okay, the last couple of months, there's actually a downtick. That's a warning flag. Okay, but that, is that really a serious downtick, or is that just fluctuation in the data? Okay, new privately owned housing permits. Okay, so this is building permits for building new single family homes. Okay, you can see kind of upward trend. Then you can see the housing market collapse. We never really fully recovered. This data goes back many years. And if you take this data and go back many years, there was kind of an average nationally and for Wisconsin. And we never got back up until that average until about a year ago. The new housing market, new housing construction market never fully recovered from the Great Recession. The reason is because a lot of the developers that were in the new housing market, they got wiped out by the Great Recession and they didn't come back. Okay. The other thing is that bankers were very hesitant to finance housing developments, okay, because they got burned in the Great Recession. You can see the drop off in COVID, but notice the last couple of periods here. Okay, you can actually see it trending downward. That's an indicator that we're heading into a recession. Okay, this is one that I tend to monitor a lot, and this is the difference between short-term and long-term interest rates. In theory, short-term interest rates should be smaller than long-term interest rates. Okay, the reason is because expected inflation, risk of default, normal profits. The longer you make a loan out for, the odds of inflation eating away the value of what's being repaid is higher. So you would expect long-term interest rates to be higher because of that. The risk of default over a longer period of time goes up, okay, because stuff happens. Russia invades Ukraine. So you would expect long-term interest rates to be higher than short-term interest rates. Sometimes they're not. Notice this, the periods here that I got circled in red. Those are all periods where the yield curve inversed. In essence, short-term interest rates were higher than long-term interest rates. Now, the thing is that this is an excellent predictor of economic recessions. You go back to the 1980s, and this indicator predicted every recession that we went into, okay, except for COVID. COVID's unique. But look at what is happening most recently, okay? The yield curve is inflated. It's inversed. and it's going in the wrong direction. If history repeats itself, we're heading into a recession. Okay. Now, one thing I want to finish up with is the Wall Street Journal provides a service where they survey, in this case, 68 individual organizations and universities that do economic forecasting. They used to do it on a monthly basis. Now they do it on a quarterly basis. Now, one of the things that's really kind of good about this is that what the research suggests is that if you've got a room full of 50 economists and all they do is worry about doing economic forecasts, and you pick one of those economists at random and ask them, what's your forecast? They're probably going to be wrong. But if you take an average across those 50 economists, that average tends to be pretty accurate. Now, that's what we're doing here, okay? What I did is, and this is January of 2023. They used to do it monthly. Unfortunately, they're doing it quarterly now. So the January one is the most current that I can get my hands on, okay? So you got to take these with just a tiny bit of a grain of salt. Now, what I did is I took the average forecast, or I took the 50 responses, the 68, and I averaged them. And then I computed the standard deviation, and I added one standard deviation and I subtracted one standard deviation. Okay, that's what that bar is. So that center part there, the black box with the orange around, that's the average. And then that top and the bottom, the width of that line is essentially saying how confident are we in this forecast. Now, notice what's happening to the average. Okay. Basically, they're saying that the average forecast is that for this current quarter that we're sitting in right now, growth should be flat. Okay, we should not be experiencing any growth. Some economists are saying we're going to go into recession this quarter. Some are saying, no, we're going to grow. Okay, now go into the second quarter, 2023, we're going to go into a mild recession. But yet there's still a number of economists that are saying, no, we're going to slow down, but we're not going to go into a recession. And then you can see the recovery coming out of it. Okay, so based on GDP, the consensus is we're probably going to go into a recession, but it's going to be a very, very mild recession. It will be very short term. Now, this is based on the December forecast. It's the January survey, the December forecast. What's happening here is that I think when we look at the current, when that becomes available, is that this U-shaped pattern here is going to continue to hold, but it's probably going to shift out to the right a little bit. Okay. What about inflation? Argument is that inflation is going to start coming down. Okay. The federal policy on getting inflation under control is probably going to work. Are we going to get down to that magical 2%? Probably not. Is the Fed going to maintain that 2% goal? Are they going to be a little bit more flexible with that 2% goal? Okay. Unemployment rate. Well, you would expect if we go into a mild recession, you're going to see the unemployment rate start to tick up a little bit. Okay. That's what we would expect. Okay. 10-year interest rates. We expect interest rates, actually, this is kind of looking longer term. So this is not quarterly. This is actually June of this coming year, December of this coming year, and then a year out. We expect that because inflation is going to start coming down, we expect the Federal Reserve to start backing off. If we go into a mild recession, the Federal Reserve will probably start backing off, and we'll start to see interest rates start to inch their way down. Notice this is not a big decline. Okay. Now, when the Wall Street Journal does this survey, they ask a couple of questions. One question is, will the Fed be able to achieve a soft landing for the economy in 2023, lowering inflation while avoiding the recession? About 3 in 4 say, nope, they're not going to hit it. Okay. They're going to be too aggressive. Okay. They're going to be raising interest rates too high for too long. A quarter say, yeah, the Fed's going to get it about right. Okay. What of the following sectors will be the hardest to tame in terms of inflation? Well, gasoline prices are starting to come down. Airfares will start to come down. Has anybody booked a plane ticket lately? Oh my God. Airfares are going to start coming down because energy prices are going to start coming down. The ones that are going to be difficult, okay, is healthcare. Healthcare has always been a source of inflation. The cost of healthcare has historically increased, and it's increasing even more rapidly now. Rents. Why rents? Because of what's happening to the home ownership market. Okay. Prices are too high. Interest rates, mortgage interest rates are really high. People are saying, okay, now's not the right time to buy. So what do? I go into the rental market, and that's putting upward pressure on rental prices. And landlords are taking advantage of that. Okay. Would you think that they're going to start cutting interest rates, the Federal Reserve? Probably not, for at least for a year. Okay. At least for years, we're not going to see interest rates start to come down. Okay. Now, what's the probability of a recession in the next 12 months? Okay. Almost 80% said that it's greater than a 50-50 chance that we're going to go into a recession. Okay. The average is between 60% and 65% of a likelihood of going into a recession. Okay. This is that mixed indicator, that back to that original picture that I had in terms of that. Okay. Because we got a lot of conflicting signals that are pointing in different directions. Okay. So what do we got? Bottom line is the economy will slow down. And if we enter a recession, it's going to be a mild recession. Short-term economic issues is inflation, rising interest rates. Okay. The wild card is the European economy. Okay. And that's primarily because of the Ukrainian war. Okay. We're starting to back off on that a little bit because their winter wasn't as hard as they thought it was going to be. Okay. Long-term structural issues, sustained labor shortages. This is not going to go away. And there's three ways that we can address this. One is automation. Businesses are doing more related to automation. Second is we can increase the birth rate. Good luck with that. The third is immigration policy. We have to talk about immigration policy. Okay. So I'll stop with that and see if there's any questions.
Thank you, Dr. Deller. That was wonderful. That was a lot of great information you just shared. A couple questions that came in via the chat. It looked like on some of your earliest slides that Wisconsin's GDP and personal income growth wasn't quite keeping pace with national numbers since 2016.
Yes.
Any thoughts as to why or what the causes are behind that?
The reason is because there's a couple of states, Florida, Arizona, a couple of others that are growing just really rapidly. Texas, they're growing really rapidly and they're pulling the national average up. Wisconsin and the Midwest states tend not to be are not growing that fast. So that national average is really, you're picking up Georgia, you're picking up Florida, you're picking up Texas, you're picking up Colorado. Those states are really growing quite rapidly. Okay. And we're just not up to that speed.
One of your slides and some of your commentary talked about the idea that Wisconsin just is generating more jobs than we have people to fill those jobs. And you poo-pooed my easy solution just to increase the birthing rate in Wisconsin. It doesn't sound like that's the long-term solutions.
I don't know how you pass a policy that's going to encourage that.
Yes. But I think you did talk a little bit about immigration. What are your thoughts there? What are your thoughts about addressing that problem in Wisconsin?
I think, when you're talking nationally, it's immigration policy. Okay. We have to talk about it. That's different than, the border security. Border security and immigration policy they're really kind of different things. Okay. So at the national level, we have to talk about that. We have to talk about the visa program that allows people to come into the U.S. who are able and willing to work. Okay. How can we accelerate that? We have to talk about that. Okay. For Wisconsin, we have to talk about migration rates. Right now, there's this perception of Wisconsin has a brain drain. that that more educated people are leaving Wisconsin. Okay, that's not necessarily true. If you look at national averages, the amount of outmigration of educated people in Wisconsin is about where you would expect it to be. Where we fall down is the in-migration of educated people. So that raises the bigger question of what about migration patterns? What we're seeing is that people really aren't moving into Wisconsin. Now, the question is, why is that? Okay, we're seeing pockets. We're seeing up by the Twin Cities around Hudson. We're seeing the Twin Cities kind of growing into Wisconsin. We're seeing a little bit in southeastern Wisconsin, where we're seeing the Chicago metropolitan area kind of growing out. So we're seeing some pockets of immigration, but the overall state is that we're not seeing people moving into the state of Wisconsin. Now, the question is, why is that? Okay, a lot of people say, well, it's because of the weather. No, it's not. Because if it was, Minnesota would be experiencing the same things. Minnesota's not. Minnesota's seeing positive net migration. So what is it that Minnesota's doing that we're doing differently? And I could go on all day about that.
One last one here, as we're running out of time, on related to the housing market. I think what we're seeing in Wisconsin, and more specifically in the Dane County Madison area, is that there's housing supply is incredibly low right now. Inventory is low, even in spite of higher interest rates. Do you think that will have any mitigating impact on any potential recession we see in this area, and maybe shelter us from some of that?
You mean in terms of housing
prices and any bubble related to housing? Yeah.
Well, I think that actually, if the housing market goes through a major correction, and there's some indicators that it might be going through a correction, right? That spike up in prices over the past 2 years starting to reverse itself. We're not going to see a bubble that caused the Great Recession. We're not going to repeat that history. I don't think we are. But what's going to happen is that people are going to feel less wealthy. And because they feel less wealthy, because you think about the typical person, what is their biggest single asset? It's their house. And if the house starts to decline in value, they're going to feel less wealthy. It means they're probably going to pull back on spending. Okay. So as the housing market corrects itself, we could see that kind of seeing people pull back on spending, and that could feed into recessionary pressures. If they correct themselves to such an extent that people are underwater, their mortgage is more than the house is worth, then then all bets are off. Now, the other thing is you got to think about different parts of Wisconsin. There are some parts of Wisconsin where the market is so strong that it's not going to play out the same way. The market in Madison, for example, is very different than the market, say, in Green Bay. The market in St. Croix, with the Twin Cities moving over, is very different than, say, Janesville. Okay, so we can talk in general terms, but there's going to be pockets of the state that it's going to be a very different story.
Sure. Well, thank you again. As we wrap up here today, I'd just like to point out really quickly that you can go to svaccountants.com to sign up for our tax alerts, biz tips, future webinars like this. And there's a lot of other resources out there that can be a huge help to you. Keep in mind that our SVA team is only a phone call or an email away. So if you're a client of ours, please reach out to your SVA professional with any questions. If you're not currently an SVA client, please contact me, Lee Schwartz, our Director of Business Development, or anyone in our business development group, so that we can get you the help and the answers you need. Thank you again, Dr. Deller, for joining us today. Thank you to everyone for attending, and I hope all of you have a great and wonderful rest of your day.
Thank you.